I think Powell's very committed to an easy course, even if you believe inflation's out of control. He wants to keep rates low so that the unemployed and the disenfranchised get decent jobs. If the cost of a stronger labor market is above average inflation, so be it. Whether you agree with Powell or not, he's been very upfront that this is the plan. So I'm willing to wade into the beaten down industrial aisle and start picking up bargains tomorrow, while the mess has still yet be cleared. This group, not this group. But how about the aisles that are bustling? All right, what's there for you if you, like me, you believe that inflation is running its course and the Fed knows what to do? Well, okay, so let me introduce you to these two terms. These are really what's driving a lot of stock market action right now, and a lot of people don't know them because they've gone out of style. I want to bring them back, all right? Right now, there are senior growth stocks and junior growth stocks. As much as I love the term FAANG, that is my acronym for Facebook, Amazon, Apple, Netflix, and Google, I think we need to broaden it out. Call them senior growth stocks because there are so many other senior growth stocks that are now being put in the cart. For example, we had a big move in Adobe ahead of its earnings on Thursday. That counts. This stock, which had lost its lift not that long ago, actually hit its all-time high today. It better be good when it reports. Microsoft works. NVIDIA, right? And after a long dormancy, Salesforce is starting to run too. When the banks plummet, the money flows into the financial technology plays, banking light, so to speak. So that means Square and PayPal see panic buying. Maybe fintech should have its own aisle. Then there are the junior growth stocks, smaller and faster growing than their senior components. Now, there's, for instance, these stocks have been roaring. There's Twilio, the fantastic company that lets app developers push messages to the customers, among other things. There's Roku, which is the cord-cutting kingpin. CrowdStrike, we just had them on, right? They stopped crypto kleptos. Etsy, the online marketplace for all sorts of handcrafted goodness based in Brooklyn. And DocuSign, which has become the de facto way to close deals over the internet even after the pandemic. Junior growth stocks are beloved by Kathy Wood of ARK Invest, who had an incredible year in 2020 but was struggling in 2021 until recently. Often she seems to keep these stocks all by herself. Now, I am not against FAANG and friends. I've been a huge supporter of the senior growth stocks, especially Amazon. But I'm beginning to believe that it's time to examine the stocks in the godforsaken aisle where people keep slipping on copper and lumber and iron ore because now those stocks are going down. If you think, as I do, that the Fed will keep the fires going, you want to own a steel stock or a heavy machinery player or a chemical company. Cleveland-Cliffs, it was down $2 today. Could go down under 20. You got to probably buy it then. If Caterpillar comes to 200, I mean, come on, let's buy that one. Dow Chemical, good yield. I even sanctioned some energy stocks because many of these companies have changed their suboptimal ways. Chevron, Pioneer, even Exxon. These are the kinds of companies that thrive when economies around the world are growing. And that's exactly what I expect.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.